So, good morning, everyone. Welcome to this, another course Zoom session. Once again, we are online. We are not sure how it's going to progress for the rest of the semester, because as I mentioned to you last time, the room was not yet ready. And in addition to that, the room to which we were assigned, it was oversubscribed. So I'm not 100% sure how we are going to progress. I'm going to be guided by the bigger heads. So make sure that you check on the course page to ensure that you know whether we are online or we are going to be face-to-face. Christina?
Yes, Miss. Good morning.
Good morning, my dear.
Will the tutorials be online also, or should we go?
No, darling, all tutorials are face-to-face. Thanks for asking that one. All tutorials are in the face-to-face mode. All right? All tutorials. And I'll be sending out a note to you in the news forum before the end of the week to get you ready for next week. Because remember that your tutorials begin next week. Another thing I need to say before we start up, I saw some persons asking how do they access the recordings for this session. Guys, all you have to do when you click on the Zoom meeting room, you look for cloud recordings and you just click on cloud recordings and you will see the list of all the recordings and you just look for the one that relates to your session. All right, like this week's own, I made sure I put beside it that it is M16. I'm going to go back and see if I can modify the others that are there to specify the stream. All right, guys. All right, oh, Jones, terrible feedback. Savio? I'm getting a terrible feedback. Wow. Let me see who it is. There is a horrible feedback coming from somebody's microphone. Guys, please keep your microphones off. All right? Until you need to speak with me. Please, just check to ensure that your microphones are in the off position. All right? All right, guys. So before we get into the meat of the matter for today, our little thought for the day as usual. And this one is coming to us from Winston Churchill. It says here, continuous effort, not strength or intelligence, is the key to unlocking our potential. Continuous effort. So guys, we have to be consistent. You don't have to be so intelligent, but you have to put in the effort. All right? So then, guys, where did we left off last time? We were looking at the IASB framework, the International Accounting Standard Board, which replaced the International Accounting Standards Committee. And that the framework that was put forward by the Standards Board spoke to three things. Firstly, it looked at the objective of financial information. Not true? What's the objective of financial statements? It is to provide information to users outside of the entity who are going to be making decisions about the entity. The decisions that they make should we invest in this business? Should we lend to this business? Then the second thing that the framework spoke to was the qualitative characteristics of the financial information. Can anybody remind me of some of those characteristics? We'll take about 3 of them.
Understandability, time
It
period.
must be understandable. Yes, indeed.
Must
What
be
else?
reliable, and it must be relevant.
Reliable. Because
Comparable.
people are depending on it to make their decisions.
And it must be relevant.
It must be relevant. Who speaks to the reliability? Who tells you that this information is reliable? Who can you depend on?
Miss an auditor?
The auditor. Beautiful. The auditor. Because they are going to tell us, when they audit the statements, they'll tell us whether these statements give a true and fair view of the financial position of the business. So the third thing, guys, that the framework spoke to was the accounting elements. And we said that the 3 elements are assets, liabilities, and owner's equity. And those 3 elements, we put them together in what is referred to as the accounting equation. Now, we said that in a sole proprietorship, owner's equity is referred to as capital. So you would have said assets is equal to liabilities plus capital. But remember, I was saying to you last week, is that this equation could just simply say assets equal liabilities. And by the end of the session, you will agree with me that yes, we could say that. In fact, in a few minutes, you're going to agree with me. Remember, guys, assets are economic resources. And the other side of the equation, liabilities and owner's equity, these are claims against these resources. So what we are going to do now is to have a closer look at each of these 3 accounting elements. Now, the basic accounting equation says that assets must be equal to liabilities plus owner's equity. But by the end of this session, we are going to have a new accounting equation, what we call an expanded accounting equation. So let us start off by looking at assets. Now, for many of us who have done accounts before, when we see the word asset, we think about what? What do we think about?
Companies valuables.
Valuables, things that you own, not true, things that you own. But I put it to you guys that assets goes beyond what you own. For those who have done accounts before, you would have done something about leases. You have different types of leases. You have finance lease, you have operating lease. So when we talk about assets, remember we know they are economic resources. So these are economic resources that a business use to generate earnings or assist in generating their earnings. Now, the earnings of a business, guys, is referred to as revenue. Write down that word for those who are doing accounts for the first time. Revenues, the earnings, revenues. Now, our assets can either be current or non-current. For those who have done accounts before, non-current is the same as fixed. Now, when you see the word current, think about a 12-month period or what we call the accounting cycle. So current always speaks to the accounting cycle, which in most instances is 12 consecutive months, 12 months. So what do we mean by our current assets? Current assets, remember, assets, you use them to generate earnings. So if they are current assets, it means that we plan to convert them into cash or generate earnings in the next 12 months or accounting cycle. So typical examples of current assets would be like our cash, our accounts receivable, our notes receivable, supplies. If you're a merchandising business, inventory would fall here as well. Or goods. Some people know it as goods. Now, guys, you notice I have that notes highlighted in red. Now, for those who have never done accounts before, when you see the word receivable, think about it. If you are a merchandiser, you can sell your inventory either for cash and get the cash right away, or you could sell it on account and then the person pays you later. So what they're going to pay you later, we call it receivable, accounts receivable. It relates to what you are doing, what we call your core activity. So that's what receivable is. So they promise to pay you later. Receivable. Now, if that promise is in writing, they call it a note receivable. A note receivable. So it's a little bit more, you know, than just basic receivable. A little bit more serious than basic receivable. Lawrence, your hand is raised.
Yes, Miss. My power went a while ago, so I wasn't able to hear any of what was said until just now. So I just came back. Is it possible?
No, I'm not going to go back. What you're going to have to do is to go and listen to the recording. I'll just quickly say to you, we just started looking at assets. Yes, and we say that they are economic resources that are owned or controlled. And we said that they can either be current or non-current. And I said current relates to the 12-month period or the accounting cycle. So we are just looking at examples of current assets now.
Okay.
So I was singling out the receivable and was saying to you, receivable relates to a promise to pay the business sometime in the future. So like when you sell goods on account as a merchandiser and the people say they're going to pay you later on, then that is called a receivable. Because you see, once you are selling on account, you're trusting people. I see somebody put in the chat if that is debtors. Yes, debtors. So once you sell on account, you have debtors. You're going to have what we call a collection policy in place. So say how you're going to collect. From them, how you're going to collect your receivables. So and I'm saying to you, if that promise is in the form of a written statement, we call it a note receivable. All right? So those are our current assets. Our non-current assets now. We didn't buy these guys to sell them back. We never buy them to convert them into cash within the accounting period. Why we buy them? We buy them to assist us in earning our income or revenues.
We buy them to generate cash.
Yes, we are going to use them. And the thing is about these non-current assets, you plan to use them for more than 1 year. That's what makes them non-current. Remember, current relates to the 12 months. Non-current outside of 12 months. So typical examples of non-current, or remember I said the same thing that you call fixed assets, would be like furniture and fixtures, land, building, equipment, machinery. They always combine all of them together, guys, and they call them P, P, and E. What that means? Property, plant, and equipment. So if you're reading any text and you see them refer to something called P, P, and E, those are their non-current assets. Property, plant, and equipment. All right? So we not buy them to sell them back. But let me tell you from now, it doesn't mean that you can't sell them back. But look here now, when you sell a piece of non-current asset, what you get from the sale, listen me good now, is not revenue. It is not revenue for the business. Then what it is, we soon talk about that. All right? So you buy the non-current assets to help you to earn your income, to enhance your earning power. You don't plan to sell them back, but you can sell them back. All right? So that is for the assets. Now we turn to look at the liabilities. Remember we said assets, what the business own or have some kind of controlling interest in. So what are liabilities then? Now must be what they own. What the business owns. Debts payable. Now, like our assets, liabilities can either be current, but we don't say non-current liabilities. Or sometimes some people say that, but long-term. Now remember, we say current relates to 12 months or the accounting cycle. So clearly then, current liabilities must be what the business have to go pay off within the next 12 months or within the accounting cycle. Are we there? And long term now must be outside of that 12-month period. Long-term liability. Now, guys, typical liabilities. Remember, we said what people owe us, what our debtors owe us, we call it receivable. Now, when we owe persons, we call those persons our creditors. So what we owe them, we call it payable. So typical liabilities, accounts payable, notes payable, bank loan, mortgages. Now guys, Let me say something to you. Sometimes you may go into an assessment. The examiner don't ask you to explain to them the difference between a current liability and a long-term liability. In accounts, for those who have done accounts before, you remember you have something you call a trial balance. So
Yes.
supposing they give you a trial balance, and in the trial balance now, those who not do accounts, don't worry yourself. Just listen to what I'm saying, because it's just reasoning out something. There is a mortgage of $2 million. We are now, supposing we were at the end of 2021. And when you take up the trial balance at the end of 2021, in it, there is a mortgage for $2 million. And then now, they give you a note to the trial balance. Hear what that note says. It says, listen what it's saying now. It says, $500,000 from the mortgage is due to be paid on July 31, 2022. Now, the mortgage is $2 million. But they're telling you that 500,000 out of it is due to be paid in July, at the end of July next year. You notice where July would fall? Wouldn't July fall within the next 12 months? Not true. So what that would mean, guys, is that when you are doing up the statement in which we are going to show that mortgage, we're not going to name of the statement, little more. You will have to split that mortgage into two pieces. The 500,000 that is due at the end of July next year, in the next 12 months, we're going to show it under current liabilities. And the remaining 1.5 million, we're going to show it under long-term liabilities. Are we there, guys? So remember, you have to know the theory so that you can apply that theory. So remember what a payable is. Promise to pay a debt arising from a purchase on account or a credit purchase, or from the receipt of a service on account. All right, guys? So that is liability. So far, our assets, we have non-current assets, we have current assets. Liabilities, we have current liabilities, we have long-term liabilities. Let us now turn to the third element. And the third element is our owner's equity or capital. Now, remember I said to you that the equation could just say assets equal liabilities. Why did I say that? I said that to you guys because owner's equity is a special type of liability. Why is it special? It is an amount that is owed by the business to the owner. You remember last week we talked about something called the entity concept? And we said that from an accounting perspective, the business and the owner are deemed to be different entities, separate entities. So the entity concept. So capital is a liability. The owner has lent this money to the business. Yes, from an accounting perspective. But remember, from a legal perspective, it's not so. So your owner's equity, remember the equation says assets is equal to liabilities plus owner's equity. So when you look at this now, liabilities is really what is owed by the business to outsiders. Not true? Yes, but owner's equity is what the business owes to the owner. So this owner's equity is also referred to as your net assets or your residual equity, or sometimes you hear them talk about your net worth. What's your net worth? Or they're saying to you, take your assets, minus from that your liabilities, and that is your net worth. So you see then, guys, if you have a negative net worth, you're in serious problem. Not true? See me transpose the formula there for you. If assets equal liabilities plus owner's equity, then owner's equity must be equal to assets minus liabilities. You see why they call it residual equity or your net assets? Yes, it's what is left of your assets when you take out your liabilities. So guys, if we should now at this stage rewrite the accounting equation, what would it say? Wouldn't it now say to us that my non-current assets plus my current assets must be equal to my current liabilities plus my long-term liabilities plus my owner's equity? Isn't that correct? That's not right.
Please, can you
Yes,
Miss, can you go
ma'am.
over that, please?
I'm saying to you, remember, the accounting equation says assets will be equal to liabilities plus owner's equity. We looked at assets and we saw that assets can either be current or non-current. So we have replaced asset with non-current assets plus current assets. Liabilities. We saw that our liabilities can either be current or long-term. And then we add back the owner's equity. It's like a math we're using, man. You get that now?
Yes, Miss. Yes.
Robinson, what you say? You never pass, but sis, what kind of business you're going on with?
Miss.
Krishna! Oh, come on, guys. Little bats that man. And we don't reach nowhere yet. Huh? Come on. See me taking my time. So guys, before we go to the question, we're going to see now if we can apply what we have just done there. Myri, you want to ask something, my darling? Go right ahead.
Miss, can you please repeat what you said before you started reading the chat?
Oh, I was saying to us, the basic accounting equation says that assets is equal to liabilities plus owner's equity. But when we look at assets, we see that assets can either be non-current or current. So replace assets with non-current assets plus current assets. And we saw that liabilities can either be current or long-term. So replace liabilities with current liability plus long-term. And then we add back the owner's equity. So it's the same accounting equation. but it's a new way of putting it. You get me?
Yes, Miss. Thank you.
Okay, my darling. Longbridge, boy, whether face-to-face or online, you know, it's the same thing we're going to say. It's the same presentation we use on Monday with the other class.
Miss, I don't know. I'm trying to grasp and I'm getting confused. So I don't
You have
know.
never done accounts before?
I did it in third form, but that was like basic accounts. I didn't do it.
So this is what you would have done in third form?
No, I just remember about balance sheets. I don't really remember.
Okay, we don't ever reach there so yet. We don't reach there so at all. But you know that there are several streams. So even though you're not registered for a stream that is face-to-face, and yes, if you want to come to the Monday class or any other class, supposing this one will have to stay online, then anybody, once you registered in the course, you can go. So any other stream you can fit into, my darling, feel free. All right? Feel free. All right, my darling. And remember, you can always get in touch. I understand that some persons have issue. Once Brown, once the room is sorted out, we will be there. But just in case this stream has to stay online, then you can come in and fit into any other of the face-to-face. Because everybody has their own learning styles. We are aware of that. All right? Okay. So let us now see, guys, if we can apply this to a question. Let's see if we can now apply what we have just covered to a question. And this is the question. Nakiba?
Yes, good morning.
Good morning.
Just want to ask a question based on the questions that were asked before. We don't have to register if we want to change the stream. Right?
No, thank you for asking that. Don't even think about it. Don't touch your registration, none at all. Okay. Don't touch it, none at all. Even, you see, if you register for a tutorial already, and you think that, boy, no, I shouldn't try and register for another one, because that other one is more convenient, don't touch your registration. Just send me a note, tell me you registered for the tutorial on Monday at X time, but you think the one on Tuesday at Y time would be more convenient. So you're going to register, you're going to go to that, you're going to attend that one so that I know that you are in a tutorial. Are you there? Don't trouble your registration, none at all. Because you see, if you're going to drop and then say you're going to add back, when you go back, there is no space for you. Because people are still there waiting for overrides. And the limit on each class is 160.
Excuse me, Miss.
Yes.
Miss, for like the tutorials, I think Malachi Lewis, I think you accepted me for this class. And for the tutorials on my schedule, I don't think I have seen anything for tutorials. Like I don't like normally.
Yeah, go ahead.
Normally it will come up, for example, econ. You see a tutorial class for certain stuff, but for this I don't see the tutorial class. But
did you register for it?
Yes, Miss, and I think you gave me the override for me to sign it.
I granted the override.
Yeah.
Well, all you have to do, my darling, don't go back and get trouble anything. Just look at the hours and the one that is most convenient. You make sure you go. Tell me which one you're going into. Send me a note. And when you go to the tutorial session, you make sure that you put your name on the register because registers are taken. Remember, 5% participation?
Yes, Miss, and I heard that, yeah, like you gave 2 Louis, me and somebody else. So I just trying to get that figured out.
I gave what?
I heard that you, like, the person I spoke to my mom and she told her you gave a bypass to two persons last name is Lewis, and I'm one of them. So just trying to find out the
Oh,
tutorial.
yes. Okay. Oh, this is Louis. Okay. Yes, no problem. No, just go to the one that you can fit into and make sure you add the name to register. All right? Because once you have access to the course page, it means that you are in good standing. All right, Mary, last question, and then I'm getting on, guys. Yes.
Miss, I was adding to him.
You're welcome, darling.
Adding that he can just check week 3 of his schedule and it will show up right there, just as mine.
Because tutorials begin there. Yes, so maybe that's why he's not seeing it. Thank you, my darling, for that bit of clarification. So, guys.
Thank you very much.
Miss, you want the answer for this?
No, don't tell me no answer yet. Wait. Guys, see the question here. You see, remember I tell you you're getting multiple choice questions in your assessment? Hear what now? In our multiple choice, I'm telling you from now, I don't want nobody ask me when they get the result. Miss, how me get X number right and then I only get Y mark. Look here. Our multiple choice questions have different weightings. Some carry 1 mark, some carry 2 marks, some carry 3 marks. This on the screen is a typical 3 marks question. So it says, owner's equity and total assets were 32,000 and 79,000 respectively at the beginning of the period. Now, when you're doing maths, I always tell my students, write down what you are given. So from that first sentence, I am getting that at the beginning, owner's equity is 32,000. Not true. Total assets, 79,000. I know the equation says assets is equal to liabilities plus owner's equity. So the first thing that stands out for me, then what is my liabilities? Not true. What were the liabilities at the beginning of the period? So that is something we need to sort out. They go on to say, assets increased 50%. Quite clear because assets was 79 and they tell you it's going to go up by 50%. Liabilities decreased 60% during the period. Yeah. I no figure for liabilities. So it therefore means before I can even attend to that part, I have to find out what liabilities was and drop that figure by 60%. So the big question is, what is owner's equity at the end of the period? So first things first. So let's take it on. Step 1, I'm going to work out what my liabilities were. So here we go. We know assets equal liabilities plus owner's equity. So I am going to make liabilities the subject of this formula. So it means that my liabilities must be equal to my assets minus my owner's equity. So that means it is assets of 79 minus owner's equity of 32. So that means it is 47. Now, guys, you know that you're doing multiple choice. You know that that is one of the answer choices, though. And some people, they see the 47, then jump right away and share that answer. Wrong. They did not ask you what was the liabilities. So we take the next step now. In the next step, they tell us assets increased by 50%. We know assets at the beginning was 79,000. So we can either say the assets now at the end will be 79,000 plus 50% of 79,000, but we're bigger than that. We are not big mathematicians, man. So we can't just say assets will be equal to 79,000 times 1.5. Not true. It's the same thing as saying 79,000 plus 50% of 79,000. So it means that my assets at the end is 118,500. Now, for the liabilities, what did they say? Liabilities went down by 60%. So the 1 year now, let me do it in 2 ways too. Liabilities was 47,000 and it went down by 60%. So I could say now that my liabilities was 47,000 minus 60% of 47,000. But where are my big mathematicians? How else could I put it?
0.6 times 47,000.
That is saying the same thing as what I have here, so no. Something that captures the full thing.
0.6.
Put the 40% of the 47,000.
40%. Good guys. Instead of saying all of that, I could just say liabilities is the 40% of 47. Are we there? But no worry yourself. If you not figure it out that way, do it the long way. 47 minus 60% of 47. And you work that out. What is my liabilities? 47 minus 28, 2. So18, 18,800. We don't get the answer yet. They ask us what? What was the ending owner's equity? I'm going to skip slide now, guys. So make sure you have all of those steps.
Miss, give me a second.
Yes, man. No problem, my darling.
Miss, you can move on now.
Okay, darling. So here we go then, guys. We want to find that ending owner's equity. So we know owner's equity is assets minus liabilities. So it's a 118,500 minus 18,800. So what's my answer? 99,700. So my friend asked me if you want the answer. That's what you got?
Yes, miss.
Beautiful. Beautiful.
Miss?
Yes, there?
Oh, sorry, miss. I was wondering, since you said the question is worth 3 marks, right? We don't need to, if we just put the figures only for the question, will we get the 3 marks, or we have to put
a multiple choice, man? You get a 3 mark from your from a workout, from your shared answer. Yeah, man. You can do your thing shortcut. Come on, says multiple choice, you know.
Oh God, true. You ask them if we just put the answer alone, we'll get like maybe
no, man. That is if it's a constructed response question. Now you have to show me the workings.
Oh yes.
Yeah, but if it is just multiple choice, no, man. And you can't find a shortcut to get all the answer. Who you get it? But I'm doing all of this detail for those who have never done accounts so that they can see the flow.
All right, thanks.
Yes, ma'am. All right, my darlings. So, guys, as we go through, we're writing and we're whistling. We do theory, we apply the theory. That's how it goes. So we're moving on. So the next concept that we want to explore, to expand the accounting equation, is the business of revenues. Now, guys, Even for my friends who have done accounts before, my friends who have done accounts before, I want you to stay focused here. Guys, please check your microphone. Somebody's microphone is open and we're getting a feedback. I'm trying to find out who it is. I don't want to take away your privilege at all. So you make sure that you put your microphone in the off position. Please do. Now, even my friends who have done accounts before, I want you to make sure that you stay with me for this one. Remember our accounting equation as we go through. Remember the accounting equation, the basic one. Assets equal liabilities plus owner's equity. Now, when we think about revenues, we define revenues, remember the earnings, you know, as what is received or to be received from sale of a product or provision of a service. And we recognize revenues when they are earned, not when you get the money necessarily, when you earn them. So notice, guys, it says received or to be received. If it is received, work with me now, you know. What is it? If it is received, what you get? You're a bit muffled. If it's received, what do you get?
Cash.
Cash. Beautiful, my sweet lady. Cash. If it is to be received, what is it?
An account.
Account what?
Account receivable.
Account receivable. Stay with me, you know. If you receive it, it is cash. If it is to be received, it is account receivable. Now, whether it is cash or accounts receivable, guys, we're talking about assets. Not true?
Yes, miss.
So we can say revenues are assets which come into the business from goods supplied or services rendered. That's how it goes. So we get the assets from our earning of revenues. Now, guys, we talk about the accounting equation. So we have to be looking at that accounting equation. What? Me get cash or they owe me? So that's on the asset side. And me earn revenue. What the owner put into the business to earn on it? What we call what the owner put into the business?
Owner's equity.
Owner's equity. Owner's equity. So look here, let me give you some examples of revenue. Depending on the nature of your business activity or what we call your core activity. If it's a merchandising business, you're going to talk about sale revenue. A service entity, you talk about service revenue. You have rent revenue, you have interest revenue, you have dividend revenue. Depending on the nature of the activity you're dealing in. Now, guys, revenues, remember we say, is either going to be cash or accounts receivable. So revenues, as far as the accounting equation is concerned, revenues increase both assets and owner's equity. Do you agree with that? So on the asset side, we're going to go up. We increase. On the liabilities owner's equity side, it also go up. So what happened? The accounting equation remains balanced. Are we there? And take it from me. Every business activity impacts the accounting equation. Every single business activity. And after you apply to the accounting equation, the equation must still remain balanced. So look here, I'm coming to you, Williams. If you increase something on the asset side, you have to increase something on the liabilities owner's equity side. If you decrease something on the asset side, you have to decrease something on the liabilities owner's equity side. What if the impact is fully on the asset side alone, or fully on the liabilities owner's equity side alone? Use your maths to answer that. What if the event only affects one side? What you going to mean?
That it's unbalanced?
It must remain balanced. It must have a balance. If it unbalance your balance sheet, I saw your balance sheet no balance. If it is on one side only, guys, it means something must go up and something go down on the same side. On the same side, because it's a one go up, supposing we're talking about two asset accounts. One go up by 10,000, one come down by 10,000, then the equation is still balanced. You can visualize it. Make we go a little further. But remember this one. For revenue, the increase is on the asset side, coming in either in the form of cash or account receivable, and increase on the owner's equity side. So notice we're adding on revenue to owner's equity. Make we take expenses now. So expenses paid or to be paid. Paid or to be paid for costs incurred in earning your revenues. And we have to recognize these expenses when they are incurred, not necessarily when they are paid. As soon as we incur them. So guys, look at this now. It says paid or to be paid. So if it is paid, what is going to happen if you pay the expense? Just talk to me normally, no accounting. Don't think nothing about no account.
Is the assets when the cash would decrease or bounce?
The cash going down. Beautiful. So that is asset, cash, gone down. What if it is to be paid?
Liabilities increase.
Liabilities gone up. Notice, you know, guys. So if it is paid, cash go down. If it is not paid, then my liability goes up. So on that side, on the asset side, my cash would go down. if it is paid. What do you think is going to happen on the other side? If it's pay, you pay.
Liabilities goes down.
Liabilities interfered with? Let's take the two pieces. If it is paid, my cash go down.
And your expenses decrease.
But it's the expense me paying. On the other side of the equation, me talking.
Owner's equity is reduced.
Owner's equities. Nice, sweet pea. That's what I'm listening for. Owner's equity is going to go down if it is paid. But look here. So the two sides, when I pay it, my asset side gone down, my owner's equity gone down. But look, supposing I never pay it. Remember, you tell me that when it's not paid, my liability gone up. Notice in the equation, I am on the side now with liabilities and owner's equity. So if I don't pay it, guys, it means that my accounts payable, which is a liability, gone in which direction? Come on, talk to me. What happened to the liability? Where it gone? Up or down?
Increase.
It's gone up. Yes. And owner's equity at the same time gone down. I wonder if you see the math. We are on the same side of the equation. So the liability gone up by $10,000 and the owner's equity gone down by 10,000. Equation still balance. Equation still balance. So whether we pay it or we owe for it. So typical examples of expenses. Notice here, guys, I have supplies used. Supplies here is talking about stationery and supplies. So the portion that you use up is an expense. And notice rent. Rent can fall under revenue and it can fall under expense depending on the type of on the business. All right? So you have to read good and see. So, make us see if we can summarize it now. How would an expense affect the accounting equation? Notice it decreases assets. That is, if you pay out in cash, or increase liabilities and decrease owner's equity. So if you're doing accounts for the first time, I would say write two different sentences. The first one, decrease assets and decrease owner's equity. And the second one, increase liabilities and decrease owner's equity. So if you pay it, it bring down your asset cash and it bring down owner's equity. If you don't pay it, it increases your liabilities, but decrease your owner's equity. Make sure you go over the second one good, because it's two different prongs. All right? So that is for the expenses.
Yes, I can repeat what you just now.
Huh?
I can repeat what you said just.
Okay, I'm saying if the expense is paid, it will reduce your asset cash and reduce your owner's equity. That if the expense is paid, reduce cash, the asset cash, and reduce owner's equity. If it is owing, it will increase the liability, accounts payable. It increase the liability, accounts payable, and decrease owner's equity. And decrease owner's equity. All right? So the next thing that we want to look at, guys, is this thing that we call drawings. Let me tell you something. Don't let me see anybody put drawings as an expense. Drawings is not a business expense. Remember the entity concept. What is drawings? Drawings, some people are going to tell me, is the cash that the owner take out of the business. And only cash. Cash or any other asset that is taken by the owner out of the business for their personal use. Any asset. So look here now. Look at it. Look at the accounting equation. If I take out cash or any other asset, what is going to happen to the asset side?
Decrease.
Decrease.
It is going down. Beautiful. And remember, owner's equity on the other side.
Decrease.
Going down too. So see how easy? You reduce assets, drawings, reduces assets, and reduce your owner's equity. And remember, I tell you, don't put it in the statement that show expenses, because it is not a business expense. So make we wrap up what we just said in a nice little diagram and fix up the equation. Expand the equation now. So we have owner's equity as the center of everything. Now, when the owner just start business, when you just start, they have a concept in account they call the going concern concept. Going concern means that you don't have any intention of stopping doing what you're doing anytime soon. Going concern. We are going on and on and on. Now, after we saw, if a business has just started, beginning capital is 0. Are we there? If I just start business, me no have nothing in there yet, but I'm going to put in something. How do we define beginning capital, guys? Beginning capital is what the business would have accumulated from prior years' operations. That's how we define beginning capital. So what we put in the business, we call it additional investment or investment. So coming in the business, we have the owner investment. Based on what we talked about a while ago, we also have revenues coming in. Not true? So what the owner puts in and revenues, they serve to increase owner's equity. And you must know these little rules. What is going out? What reduces owner's equity? Didn't we see what the owner takes out of the business, as well as expenses? Those serve to decrease owner's equity. So you must remember these things. Increasing owner's equity, owner's investment, revenues. Decreasing owner's equity, what the owner take out, and expenses. All right? So if we should now tack this on to our accounting equation, this is how our accounting equation now going to look. The expanded accounting equation. Remember the first thing it say, assets equal liabilities plus owner's equity. Then we straighten them out now and say non-current assets plus current assets is equal to current liabilities plus long-term plus owner's equity. Now we saw that there are several things affecting owner's equity. So look at me now. That's the accounting equation now, you know. So whatever I have as owner's equity, this really is our beginning owner's equity. Plus my investment as the owner, plus my revenues, minus my expenses, minus my drawings. Now, guys, I don't know if you're going to see, but for those who have done accounts before, when you look at that accounting equation, you don't see the statements them in it. You don't see the statements. I kid you not. 3 statements tie up in this one equation. 3 statements right there, so look for me. The 3 of them. But no worry, we're going to come back to it. So make sure you write down this equation and you have it here nice. Because this always comes in your assessment. Always. Always a multiple choice where you have to identify this equation. And then put in brackets and all kind of something. But don't worry yourself. We will get there. Now, the last thing I want to look at, the last concept, before we start a little bit of crunching, is the concept relating to gains and losses. Now, remember I said to you earlier on in the session that sometimes... Yes, darling?
Could you just go back for a second, please?
Sure, no problem, my darling.
Thank you.
Where is my thing back? There you go, my darling. We're good to go now?
Yes, miss. Thank you.
Okie doke.
Miss, what's
Yes,
the AI?
dear?
What's the AI?
Additional investment.
Okay.
Yes, all right. All right. So I was saying to you when we're looking at assets, that for the non-current assets, you never buy them to sell them back, but you can sell them back. And I was saying to you, what you sell them for, you can't call it revenue. You can't call it revenue. Why? Revenues and expenses, guys, relate to what we call your core activity. Your core activity. Your core activity is what the business was set up to do. That's your core. Anything outside of that, we refer to that as peripheral activities. So supposing that I am in the business of buying and selling phones, cell phones. That's my core activity. But supposing as the business, we invested like in the foreign exchange market. And I make something from that market. Get something on what I've invested. That is not revenue for me. I can't say it's revenue. That is, it's adding to what we have earned, yes, but I would call that gain. And if the money depreciate in value, I may lose on it. That may call it losses. If I sold, supposing me did have one computer I may use as fixed asset or non-current asset. And then I find out that, boy, this computer get too slow, you know. Me need to step it up. So I sell the computer. Remember, me not in the business of buying and selling computers. It's phone me selling, buying and selling. So when I sell that computer now, I can't put what I get from it in revenue. We have something when we're dealing with non-current assets that we call the book value of the asset. The book value of the asset. And when we sell it, we look to see whether we sell it for more than the book value or less than the book value. If we sell it for more than the book value, we say we make a gain. And if we sell it for less than the book value, we say we make a loss on the disposal. So those are examples that I've given to you there. They are not your core activity. We refer to them as peripheral or incidental activities or transactions. Your core is what you were set up to do. So this is not part of your core function or daily operations. Typical example, when you sell non-current assets. Now, remember we saw that revenues increase owner's equity? And we saw that expenses decrease owner's equity? So here what now? Gains, like revenues, increase owner's equity. And losses, like expenses, decrease owner's equity. So they are not the same thing, but their impact is the same. Remember I said to you guys that revenues and expenses relate to your core activity. That is the principal revenue producing activity of the business. That's your core function, what you were set up to do. I was set up to buy and sell cell phones. That's my core activity. Now, later on in the course, not in the midterm, but more like when we reach to the final exam, you're going to see that when we are doing up the statement, we have a section in the statement that deals with revenues and expenses, and a section that will be dealing with things like gains and losses. Things outside of your core activity. All right? So make we see if we can use the rest of this session now to get into a couple of questions. So your worksheet, guys, worksheet number 1. And we are taking on question 1. Don't worry, if you're not seeing it, see the question there. It says, Jake's Roasted Peanuts, a proprietorship, supplies snack foods. The business experienced the following events. Guys, read good. They said to you, state whether each event increased, decreased, or had no effect on what, guys? The total assets nothing else. The total assets. So don't bother go tell me about the other things in the accounting equation. We are focusing on the asset side. And they say we must identify any specific asset. The asset side only. So we're going to identify the asset that is affected and say whether it increased or decreased and what happened to total asset. So we're taking them one by one. So the first one, Jake's Roasted Peanuts received a cash investment from the owner. So the owner put some cash in the business. So the first question, which asset is affected?
Cash.
Cash. Simply put, the asset affected is cash. Then we want to find out the effect on total asset. What direction did cash move in?
Makes it increase.
Cash increase.
It increased. Beautiful. So it therefore means that my total assets also increased. You see how it's easy? Just like that. Let's take the second one. Cash purchase of land for a building. So we use cash to buy land. Guys, stay focused. So the first thing, the assets affected. Look, we take time. You use cash to buy land. Property, assets, property.
So it had no effect, right?
Thompson said non-current asset increase. As he has said no effect. All right, make we see what's going on then now. Somebody's microphone really going on back. So the assets affected would be cash and land. Those are the two assets, not true? Then they say now the effect. Make we see. What happened to cash? Which direction cash went in?
Decrease.
Cash decrease.
Cash gone down. And what happened to land?
Miss land increase.
Gone up.
Land gone up. The two of them are assets. Not true?
Yes, Mr. No affect.
So beautiful. Total asset don't change. Because the impact is on the same side. One go up, one go down by the same amount. Equation still balance. No change in our total assets. Make we take the next one. We paid out some cash on accounts payable. Remember, it's only the asset we're focusing on. So the asset affected will be our cash.
Cash.
Yes, indeed. We're paying out cash. So it means our cash went down. So if my cash went down, it means that my total asset also went southwards. Everybody good so far? Let's take on the next one now. We are taking on event D. And that one said, we purchased equipment. But what did we do? We signed a note payable in payment. So notice now, we not pay out no cash. We owe for the equipment. So the asset affected would be our equipment. Are we there? Don't go put no cash, because they told you that you signed a note payable. That means you owe for it. So, effect on total asset, equipment came in. So, equipment went up. So it means that my total assets would also increase. Let's take on event E. We perform service for a customer. Notice, guys, on account. So it means that the customer owes us. Yes? Look at it good, Thompson.
Miss, increase in account
Brianna,
receivable.
you're telling me that accounts receivable comes into place. That's the asset that is affected. Thompson, look at what is going on here. So, accounts receivable is impacted. So, what's the effect on total asset? It means receivable gone up. So if my receivable has gone up, my total assets, my dear Thompson, would have increased. You see that, Thompson? So we go now to transaction F. The owner withdrew cash from the business for personal use. What's the asset affected? They took out the asset, cash.
Yes, so it decreased.
Yes, indeed, my darling. So it means that our cash gone down. So our total asset gone down. You see what I'm easy? Just take your time and reason them out. Make sure you read this stem of the question carefully, so you don't give any wrong answer. Look at G now. We received cash from a customer on account receivable. Take your time now. The person owes us, so they are part of our receivables. And they pay us. So what assets are affected here? What assets?
Cash and account receivable. But I would say that has no effect.
And account receivable. Yes. So the effect, my cash gone up, but my receivables gone down. So yes, indeed, my darling. Total asset unchanged, because it's on the same side of the equation. And the final one now, we borrowed money from the bank. So we got some cash from the bank. We owe the bank. So the asset affected here, no more cash, man, we get cash. So the effect on total asset, my cash gone up. So my total asset gone up. All right? So that one is warming up. So we warm up nicely.
Miss, for G, Miss, why was it unchanged?
Because both cash and receivables are assets. Yes? Both of them are assets. So the customer owes you is receivable. And you have your cash. So the customer gives you some cash. So your cash gone up. But the amount that is owed to you gone down. So it's like you owe me $10,000 and you pay me the 10,000. So my cash gone up by 10,000. But the amount that you people owe me gone down by 10. So overall, my total assets not going to change. That side not changing at all. Remember, you're focusing on the asset side. That's what the question is all about. As Shanique is saying, you just convert or swap out the assets. Huh? Or they work inversely, according to Halstead. Uh-huh.
Okay, Miss, I've seen it now. Thank you.
Okay, my darling. So make we go to the next big thing now, no? Now, you see this question too we're going to do today? We're going to do today. When we come back next week, we're going to tackle this question again. But we're going to tackle it next time. We're going to be doing nice and true accounts. But this week, we're just doing some crude account. Now, in order for us to tackle this question, we have to remember that 4 things affect owner's equity. Investment by the owner, increase owner's equity. Revenue earned, increase owner's equity. Expenses incurred, decrease owner's equity. And withdrawal by the owner, decrease owner's equity. Those are the 4 things you must remember. So make we look at the question. See the question here. Make sure you're seeing the question, you know, because after this now, we're just going to go, I'm going to just read the transaction to you and we fix it up. So they say, Bob Grayson owns and operates an architectural firm called Grayson Architecture. It's a service entity. They say, the following amount summarize the financial position of his business on April 30, 2007. So notice, guys, Grayson business. At the end of April, on the asset side, there are cash with a balance of 1,720, accounts receivable as a balance of 3,240. There is no supplies, and there is land of 24,1. Can somebody quickly add up those 3 balances for me? And on the other side, the claims against the resources, we have accounts payable, that liability, 5,4. And we have Grayson's capital, owner's equity, 23,660. Somebody else add the liabilities of 5,4 and the owner's equity, the capital of 23,660, and tell me what you get. I see you saying it is 29,060.
Same amount, miss.
Beautiful. So guys, we're starting off with a balanced equation. 29,060 on the asset side, 29,060 on the liabilities owner's equity side. So you see, when we finish this question, the accounting equation must still be balanced. So they said to us that during May, remember this was the end of April, those balances were, you know. So then starting off the month of May with these balances. And they give us a number of events that took place. And what they ask us to do, analyze the effects of the preceding transactions on the accounting equation of Grayson. So guys, I'm taking my time with you now. We're going to go through each of these and we're going to see how they impact the accounting equation. Remember, we know what impact owner's equity. Additional investment, revenues, expenses, drawings. Now, the first one, before I go and start, we start the solution. Look what the first one said. Grayson received 12,000 as a gift. Supposing it is stop there, so. Grayson received 12,000 as a gift. Look here, if it did just stop there, so if it was a full stop. This is not a, that would not be a business event. If Grayson get him 12,000 as a gift, we're not business with that. Grayson is a separate entity from the business. But look at what they say. And deposited the cash in the business bank account. Are we there? So because he deposited the gift in the business bank account, this makes it a business transaction. Are we there? So cash coming in. Grayson investing some more in the business. So make we see. All right. So see, for me, just to make everything all on the page, I've used a red line to separate the asset side. So me write back the stuff them just as they were given. So I see there already. Shanique telling me cash go up, owner's equity go up. Yes, you're onto something there. So we put in our opening balances. See them there, and we know so them did balance already. So the first one, 12,000 cash came in. So cash go up by 12,000. Capital gone up by 12,000. Are we there? So beside that 12,000, I want you to write down additional investment. Are we there? Right where you have it under the capital there, put beside it additional investment. Let's set the second one. The second one says we paid off the beginning balance on accounts payable. When we look at accounts payable, the balance on the accounts payable is 5,400. Not true? So if we're paying it off, it not means our cash going to go down. That's all. And the accounts payable also going to go down. So see we there. Are we there? So the asset side gone down. The other side, the liability gone down. Equation going still balance. Take your time and work there. The next one. We performed services for a client and we received cash of 1,1. Isn't it that we have earned revenues, guys? But the revenue is coming in the form of cash. So what we know? Didn't the theory tell us that revenue is going to increase our assets as well as increase our owner's equity? The asset in this case is cash. So under the cash column, don't I need to put in 1,1? And under the capital column, I put in 1,1. That's the revenue. So beside the 1,1, I wanted to write revenue. Are we there? Let's go down to note D. What D says. We collected cash from a customer on account. My friend had asked me about this earlier on. See it here now, live and direct. See cash here on the asset side. See accounts receivable on the asset side too. The two of them on the same side. So we get cash of 750. So cash is going to go up by 750. But our receivables going to go down by 750. That's transaction D. Transaction E. We purchase supplies on account for 720. Now, supplies is on the asset side. We purchase it on account. So that means what, guys?
Supplies increase, payable increase. Accounts
payable. Beautiful. We owe for it. So on the supplies, 720. On the accounts payable, 720. Transaction F. We consulted on the interior design of a building and we billed the client for services rendered $5,000 on account. So once again, guys, we have earned revenue. But this time around, the client owes us. Revenue earned is going to come in either in the form of cash or accounts receivable. So since this time it's on account, it's going to be part of accounts receivable, and that revenue increases owner's equity. So beside that 5,000 in that line, please put revenue. We go to transaction G, and it says there, invested personal cash of 1.7 in the business. So the owner putting in some more money in the business. So under cash, 1.7, under capital, 1.7. And that would make it additional investment. Coming down nicely. For H now, guys, we are paying out some expenses. So the first one says, we paid office rent, 1.2. From we paid, guys, it's coming out of cash. And it is an expense. So remember, we know that expenses serve to reduce our owner's equity as well. So please put beside that one that it is office rent expense. And the other one in the same vein, we paid advertising of 600. So 600 taken out of cash, and our owner's equity will go down by that 600, coming down nicely. We go to note I. We sold supplies to another interior designer for $80 cash, which was the cost of the supply. Because guys, remember, we're not in the business of buying and selling supplies, but a colleague ran out of supplies. And so we sell them some of ours. That's what it cost us. So it means that we get cash of 80, and notice supplies gone down by 80. You see the two of them on the asset side? And then the last one, J. withdrew cash of 24 for personal use. What we call that again?
Drawings.
Drawings. And what do we know about drawings? Don't we know
Drawings.
that it's going to reduce the asset?
And the owner's equity.
And the owner's equity. So 24 there, so 24 there, so. So right beside that one, drawings. So here what you're going to do for me now. You're going to add the columns down. Remembering that the figures that are in brackets are supposed to be subtracted. So add up the cash column and tell me what you get.
It's 39,980.
The cash?
Oh no, not the
What
cash.
else? You're too sharp for me, you know. You're too sharp for me, bud. Tell me the cash, where you get? The cash figure alone, that column alone.
Oh, 7,750.
7,750. That's what that column adds up to, guys. Receivables, accounts receivable. When you add up that column, three little things there, so.
4,250.
No, sir. You don't see the opening balance. Remember the opening balance.
Miss 7,490.
7,490. Beautiful. 7,490. What about supplies? Cool, like something there, sir.
Miss 640.
640. And land remain the same 24,1 because we don't buy no land or sell no land. Go over now to the other side, accounts payable.
Miss 720.
What you get for that
720.
one? 720.
720.
Yes. And the capital one now. Not something to add and subtract. What you get over there, sir?
Miss 39,260.
39,260. 39,260. So we can skip over to the other side, the slide then. Huh? So here are my figures. When we add them up, see them there, just as you told me. Ah. So remember me tell you, the accounting equation say assets must be equal to liabilities plus owner's equity. So my boyfriend told me earlier on that when him total, him get 39,980 for that side. And when you go over on the other side, the liabilities and owner's equity, it come back to the same thing. So equation balance every time. But guys, for those who do accounts already, you know so that is the balance sheet though. You know that? Yes.
This is just a simpler format.
Ah, there you go, because you notice that owner's equity column there have everything tied up in it.
Yeah.
So notice two things, guys. The first thing you must notice, the equation always stays in balance. And the second thing that I want you to realize is that some transactions affect only one side of the equation. And if it affects only one side, one going go up, one going go down. And some affect both sides. If it affects both sides, either both of them going go up or both of them going go down. Because that is the only way that the accounting equation is going to stay balanced. So we do 2 questions, in fact, we do 3 questions today. Nice, man, we did some crunching today. Now, we said in our discussions last week that accounting is an information system. And when we looked at that little diagram that I went through with you in the first part of the session, we saw something about some annual report. And I said to you that the report is normally comprised of the financial statements. So to wrap up our session, let us start looking a bit closer at these financial statements. So what are they? The financial statement, guys, are the final product of the accounting process. Remember the action center? So they are the final product. Remember, guys, that these are the statements that are going to be relied on by persons outside of the business because they want to make sound financial decisions about the entity. Now, these financial statements, guys, are going to be speaking to the performance and the financial standing of the business. The performance and the financial standing of the business. Now, what are these specific statements? International Accounting Standard 1 tells us explicitly that a complete set of financial statements must include the income statement or your statement of profit and loss. It must have a statement of owner's equity or a statement of changes in equity. It must have a balance sheet or your statement of financial position. It must have a statement of cash flow. And anything that is not contained in those statements that we think will impact the decision of the user, we must spell it out in some notes to the financial statement. Now, remember we said that the financial statements speak to the performance and financial position. So look here, 1 and 2. That's the income statement and the statement of owner's equity. Those speak to performance. 3 and 4, the balance sheet and the statement of cash flows speak to the financial standing. So let us see if we can wrap up with the first statement. So our income statement, and let me tell you all the names that you could see. Some of you know it as a statement of profit and loss. Some of you know it as a statement of earnings. Some of you know it as a statement of operations. Whichever is used, it's the same thing. Now, this statement summarizes the revenues earned and the expenses incurred for a specific period. You remember the expanded accounting equation? And I was telling you that the statements are all there. You remember in that equation you saw revenues and expenses? Yes. Now, if our revenues are more than our expenses, which is what we must aim for, we say we have made a net income or a net profit. And if our revenues are less than our expenses, we say we have a net loss. Now, there are two types of income statements. We have what we call a single step income statement. In that single step income statement, all revenues and gains, we put them together. All expenses and losses, we put them together. And we come up with the net earnings. So that is what we are going to be doing in our midterm for the service entity. And secondly, we have what is called a multiple step income statement. That is the one that we are going to do in our final assessment. So let us see if I can wrap it up with a visual image of this income statement. Notice I said it is for a period. So it's our income statement for year ended. Notice it says ended. We are looking back at what took place during this year. So in this single step income statement, we start with our revenue. And then we take out all the expenses. And the difference is our net income or our net loss. So guys, when we meet next week, we are going to go to the second statement. Remember, this is a performance statement. And that second performance statement we're going to go to is a statement of owner's equity. So I want you to do a little bit of reading up for next week. And when we come, we wrap up, and then we are going to revisit question 2 and do some true accounting. So I'm going to put up some sheets there for you with some T accounts. Please make sure that you print them, or if you can't print them, you just rule up the T account so that you will have them when we are going through. All right, guys?
Excuse me, miss.
Yes, my dear?
Miss, where could I find the recording for the class?
Yes. I was saying at the start, all you have to do, you click on the Zoom meeting room, and when you go there, you're going to see something that says cloud recordings. You click on cloud recordings and you'll see the list of all the recordings.
Okay, miss.
All right, my darling.
Would we have to source the text for ourselves and the self-directed readings?
No. We don't pressure you to get the text at all. We provide you with some summary notes there, guys. And accounts is account. So any text that you get, you can read up, eh?
Okay, thank you, miss.
Yeah, man. And for the worksheets that you are furnished with, guys, a lot of the questions on the worksheet, I make sure that they are past paper questions. So you'll be good to go.
So we won't be meeting face-to-face next week?
As I said at the start, guys, just make sure that you double check online, because I'm going to make a posting for you. So you will know whether or not we are going to be online or we are going to be face-to-face. If it's face-to-face, we'll tell you where. All right?
Excuse me, Miss.
Yeah. Yes, I'm listening.
All right, so for the worksheet that we're seeing there, this is what we should bring to the tutorial next week.
Right, because you notice that we have done some of the questions here in lecture.
Yeah, yeah.
So the tutor now will do some, and I'm going to make a posting in the news forum, reminding you of your tutorial hours and telling you the questions that you must prepare for next week, which could include some of the practice questions. Are you there?
Yes, Miss. Thank you.
All right, my darling. So guys, enjoy the rest of your week, and I'll see you next week, whether it be online or face-to-face. God's willing, I'll be with you. All right?
Okay, Miss.
I miss.